In every conclusion of value report, there are 3 valuation methods that must be looked at. There's the income approach, which is a cash flow-based approach. There's the market approach, which basically compares your business to other companies in the similar industries. And there's an asset approach that's going to take the fair market value of the assets minus the fair market value of the liabilities to determine the value. There are some common income methods that we see being used for closely held small businesses. The most commonly used one would be the capitalization of earnings method. The capitalization of earnings method starts by using historical financial information. Typically, this is tax returns or financial statements. We then take that financial information and we adjust non-cash items such as depreciation expense to see what the actual cash flows were over 3 to 7 years. We then take those adjusted cash flows for 3 to 7 years. We then adjust out personal items, one-time events, or anything else that created abnormal cash flows. The complicated part about the capitalization of earnings method is coming up with a rate of return. Without getting into too many details, it is going to be a rate that we apply against those adjusted cash flows. For example, if the rate of return is 20%, then the value of the company is going to be 5 times that adjusted cash flow. The most common market method that we see being used is the merger and acquisition method. This method is going to compare your business to the sale of other businesses within your same industry. It is the most direct approach for establishing market value. This method can be applied using both private or public company data, but for most closely held small businesses, there isn't much public data available. To apply the merger and acquisition method, you need to pull transactional data from sales of other companies within your industry to find the market multiple. The market multiple will then be applied to the historical revenues of your business. One of the most common asset approaches that we see being used for closely held small businesses is the adjusted net asset approach. For starters, any real estate needs to be appraised, as does any specialized equipment. From there, the useful life will need to be determined of all of your other equipment and furniture. For tax purposes, you've likely taken depreciation expense in prior years based off of IRS standards. But we want to actually help estimate what the useful life of each of your assets are to determine the fair market value of them. After looking at the assets of the company as of a valuation date, the liabilities also need to be examined. Are there any abnormalities or any personal loans that perhaps are on the books and wouldn't be carried with the business after the business is sold? From there, we simply take the fair market value of the company's assets minus the fair market value of the company's liabilities, and there is the value based on the adjusted net asset method. After each of these methods are calculated, the valuator has to determine which method or methods are most reasonable for the business. Capitalization of earnings method is typically more accurate for service-based companies or those with very strong operations. For the merger and acquisition method to be considered, the business must be within an industry with several similar businesses in size for this one to even be considered. The adjusted net asset method is considered the floor value. That is because no one's going to sell their business for less than it could receive by selling off pieces of its assets. We'd be happy to talk to you more about these different valuation approaches in detail. Give us a call.